Welcome to Business Training Media's channel. In today's video, we're uncovering some of the most influential corporate scandals that transformed our perspective on business ethics. In the modern era of business, ethics has emerged as one of the most critical topics in corporate governance. Ethical lapses not only tarnish a company's reputation but can also lead to legal repercussions, financial losses, and irreversible damage to stakeholders. Over the years, several high-profile corporate scandals have highlighted the importance of ethical conduct in business. These scandals have shaped public opinion, influenced legislation, and prompted companies to rethink their approach to ethical behavior. This video delves into some of the most significant corporate scandals that have redefined how we perceive and address business ethics. Let's review our list. Number 1. Enron, the poster child of corporate fraud. One of the most infamous corporate scandals in history, Enron's collapse in 2001 shocked the world. Enron, once a leading energy company, used complex accounting loopholes, special purpose entities, and fraudulent financial reporting to hide its debt and inflate profits. The company's top executives, including CEO Jeffrey Skilling and Chairman Kenneth Lay, encouraged unethical practices to maintain a facade of profitability. The scandal led to the bankruptcy of Enron, costing shareholders billions of dollars. It also exposed the complicity of accounting firm Arthur Andersen, which was accused of shredding documents related to Enron's audit. This scandal highlighted the critical role of transparency and accountability in financial reporting. The impact of this scandal resulted in the Sarbanes-Oxley Act of 2002, which was enacted to improve corporate governance and enhance financial disclosures. Corporate auditors also became subject to stricter regulations and oversight. Number 2. WorldCom, the billion-dollar fraud. In 2002, telecommunications giant WorldCom was caught in an $11 billion accounting fraud. The company's executives inflated revenues by misclassifying expenses as capital investments. CEO Bernie Ebbers and CFO Scott Sullivan were at the center of the scandal, prioritizing short-term stock performance over ethical practices. WorldCom's collapse resulted in the loss of thousands of jobs and left investors with massive financial losses. This case underscored the dangers of unethical financial practices and the need for stricter oversight of executive decision-making. The impact of this scandal resulted in strengthened corporate governance standards and greater scrutiny of accounting practices and internal controls. Number 3. Lehman Brothers, the 2008 financial crisis catalyst. Lehman Brothers, a global financial services firm, played a central role in the 2008 financial crisis. The company used dubious accounting practices, including the infamous Repo 105 transactions, to temporarily remove liabilities from its balance sheet. This misleading representation of financial health led to its bankruptcy, the largest in U.S. history. Lehman's collapse highlighted the ethical shortcomings of the financial industry, including excessive risk-taking and a lack of transparency. The fallout of this scandal rippled across global markets, leading to widespread economic turmoil. The impact of this scandal resulted in increased focus on risk management and ethical behavior in the financial sector. The Dodd-Frank Wall Street Reform and Consumer Protection Act was introduced to prevent future crises. Number 4. Volkswagen, the emissions scandal. In 2015, the world discovered that Volkswagen, VW, had installed defeat devices in millions of diesel vehicles to cheat emissions tests. While the cars passed regulatory inspections, they emitted pollutants far above legal limits in real-world driving conditions. This scandal, known as dieselgate, affected over 11 million vehicles worldwide. Volkswagen's unethical practices resulted in billions of dollars in fines, recalls, and lawsuits. The scandal severely damaged the company's reputation and raised questions about corporate responsibility and environmental stewardship. The impact of this scandal resulted in stricter emissions regulations and testing procedures globally. Renewed focus on corporate accountability and environmental ethics. Number 5. Theranos, the Silicon Valley mirage. Theranos, a health technology company founded by Elizabeth Holmes, promised to revolutionize medical testing with its Edison device, which claimed to perform hundreds of tests using just a drop of blood. However, investigative journalism revealed that the technology was ineffective and that the company had misled investors, regulators, and patients. Theranos' rise and fall became a cautionary tale about the dangers of overpromising and underdelivering in the tech industry. Holmes and her COO, Ramesh Sunnybalwani, were charged with fraud. The impact of this scandal resulted in greater scrutiny of startups and their claims, particularly in the biotech sector. An increased emphasis on ethical standards in scientific research and innovation. Number 6. Wells Fargo, fake account scandal. In 2016, it was revealed that employees at Wells Fargo had created millions of unauthorized bank and credit card accounts to meet aggressive sales targets. Customers were charged fees for accounts they never requested, and their credit scores were affected. The unethical practices were traced to a toxic corporate culture that prioritized profits over ethical behavior. The scandal led to widespread criticism, significant fines, and the resignation of key executives. It underscored the importance of aligning corporate culture with ethical principles. The impact of this scandal: companies began reevaluating sales incentives and performance metrics. Renewed focus on ethical leadership and accountability. Number 7. Boeing, the 737 MAX tragedy. The 2018 and 2019 crashes of Boeing 737 MAX planes, which killed 346 people, were linked to a flawed automated flight control system. Investigations revealed that Boeing had prioritized speed and cost-cutting over safety and had failed to address known issues with the system. Boeing's negligence led to widespread grounding of the 737 MAX fleet, financial losses, and a damaged reputation. The tragedy highlighted the ethical responsibility of companies to prioritize safety over profits. The impact of this scandal resulted in enhanced regulations and oversight in the aviation industry. Increased focus on corporate accountability for airline safety. Number 8. Cambridge Analytica, the data privacy debacle. In 2018, it was revealed that political consulting firm Cambridge Analytica had harvested the personal data of millions of Facebook users without their consent. The data was used to influence elections and political campaigns, including the 2016 US presidential election. The scandal exposed the ethical challenges surrounding data privacy and the responsibilities of tech companies in safeguarding user information. Facebook faced significant backlash and regulatory scrutiny for its role in the scandal. The impact of this scandal resulted in increased awareness of data privacy issues among consumers. Implementation of stricter data protection laws, such as the General Data Protection Regulation, GDPR. Number 9. Johnson & Johnson, the talcum powder controversy. Johnson & Johnson faced allegations that its talcum powder products were contaminated with asbestos and linked to cancer. While the company denied the claims, multiple lawsuits resulted in billions of dollars in settlements and judgments. The controversy raised ethical questions about product safety, transparency, and corporate responsibility to consumers. The impact of this scandal resulted in greater scrutiny of consumer product safety. Emphasis on transparent risk communication to the public. What are the lessons learned from these corporate scandals? These scandals share common themes: lack of transparency, prioritization of profits over ethics, and failure of leadership. They have led to significant changes in how businesses operate, including: Number 1. Stronger regulations. Many scandals have prompted legislative reforms to improve corporate governance, financial reporting, and consumer protection. Number 2. Ethics training. Companies have significantly increased their focus on ethics training, recognizing its critical role in fostering a culture of integrity, accountability, and transparency among employees at all levels in the organization. Number 3. Transparency and accountability. Businesses are now more aware of the importance of transparent communication with stakeholders. And number 4. Corporate social responsibility. Scandals have underscored the need for companies to prioritize social and environmental responsibility. Corporate scandals serve as stark reminders of the consequences of unethical behavior in business. While they have caused significant harm to stakeholders, they have also driven positive change, forcing companies to adopt higher ethical standards and prioritize accountability. As businesses navigate an increasingly complex world, maintaining a strong commitment to ethics will remain essential to building trust, fostering sustainable growth, and ensuring long-term success. Looking to master business and professional ethics? We've curated a list of the best online ethics training courses in the description below. These courses are taught by top industry experts, prestigious universities, and renowned organizations. Don't wait, take the next step in building your ethical expertise today. If you found this video helpful, please like it, subscribe to our channel, and share it with your network. Thanks for watching, and best of luck.